Hey folks, welcome back to the channel. It's Liquid here. And what a crazy month and couple months it's been in the markets. For the S&P 500 in the US, the year-to-date return is down about 7%. And if you have a basket of globally diversified stocks such as VEQT, which just holds stocks all around the world, you're down about 5% if you're holding this. This is a really good all-in-one ETF that I have suggested people look at previously. But there are still opportunities to make money even if the market overall is going down. So here's a look at my Interactive Brokers year to date return, up about 1%. So pretty much flat, but better than being negative. And you can see the tail end here, that last week is where most of the returns came from. And that's because the stock market is inefficient. There is an intrinsic value to every stock, which is what the stock is actually worth. And sometimes the value of the share price falls below this. And when that happens, it's a really good time to buy the stock, especially if it's a good company that's growing over time, because eventually that price of the stock will line up with its intrinsic value again, and you'll most likely make a profit from there. So that's what happened basically at the end of February, early March. I had a lot of stocks that were on my watch list that I've talked about before, and they were on sale. They were well below their intrinsic value, so I decided to buy some. I think I put in over $20,000 into the stock market, into this portfolio. And just over the last 7 days, in large part because of the extra contributions I've made, the portfolio overall returned 14%. And if we look at the value of my portfolio here, you can see it's back at an all-time high. So volatility can be nerve-wracking sometimes, but at the same time, it's also an opportunity to really buy those stocks at a discount price that you probably won't have the opportunity to do so if you didn't have all the large swings that we've seen recently. Another good time to buy is when you're feeling kind of lonely. You can purchase some shares and then you will have some company. So what happens from now? Like, where is the stock market going to go up or down? That's what I'm going to talk about today, and we're going to look at some charts and try to figure out just where the market is going, especially over the next couple of weeks. So the first thing to understand is the best time to buy the stock is when it's trading at a huge discount from its intrinsic value. The second thing to understand is that different sectors, different stocks behave differently throughout history, and sometimes one sector is out of favor and sometimes another one is really in favor. So we can't really look at all the stocks in the market as the same, and we can't expect them all to behave the same all of the time. And again, it makes it a bit more complicated because you have it's technically like 11 different sectors. However, this complication is also what makes the market inefficient, and that provides opportunity for investors to go in and really look for those attractive stocks. So, what do I mean by different sectors behave differently? Well, in 2008, the banking sector was hit the hardest. So, if you were looking at value inside financial companies, then you would have found some pretty good bargains there. So, Bank of America, for example, from '07, it was at $48, $50. And then when the financial crisis happened, it dropped all the way down to below $10. So that's a huge drop. The entire market did not drop by that much. That's like 70, 80%. But the Bank of America and other banks and financial institutions did. So I think Warren Buffett, after that 2008 financial crisis, he went pretty bullish into Bank of America and he picked up a lot of shares of that afterwards. And of course, now it's because it's a good company, it eventually recovered. And then a couple years ago, it was the energy crisis where we had oil futures essentially going to negative. So you had a lot of energy companies like Suncor, Canadian Natural Resources, Chevron, all of those like large oil and gas companies, they were hit the hardest. The overall index, if you look at the S&P 500, other equity indexes, they were down about 20 or 30%. But you can see Suncor went from $30 all the way down to like $10, 10 point something, and then up to now it's recovered. What about today in 2022? Which sector is being hit the hardest? In other words, which sector is giving us the best opportunity for future growth? And this time around, it's the technology sector. A popular ETF that people like to buy is the ARK Innovation ETF. So this one, if I go, let's say year to date, so it fell from like $97 to 65, and it actually started falling before this. Let's go to 1 year. You can see it started at 128, and now it's down at 65. So it's fallen by about 50% since its highs from a year ago. The overall market is not down that much. Like the S&P 500 is only down 7%, but this is down 50%. So that kind of tells you something. Another growth-oriented ETF with a lot of tech stocks as well is the Invesco QQQ Trust. And this one fell from about 400. It went all the way down to 324, which is quite a lot. But you can see over the last week, it has bounced back as well from March 14th to now. Year-to-date total return, so that is more than twice as much as the S&P 500. So this time, the biggest opportunities are in these high growth ETF, high growth stocks. And an ETF is just a good way to diversify your holdings so you don't accidentally pick like a stock that's not going to recover. So Triple Q is at minus 18.6 right now. If you use ARK, you are at minus 38. That's not to say that one is going to outperform the other, even though ARK is down significantly more. You just have to sort of do your own research and look at exactly what holdings are in these ETFs and see if you're comfortable holding these companies here. And a lot of these companies I actually have as individual investments myself. Like I have some Shopify that I bought over the last couple weeks. I have some Square as well. I have Tesla. So that's kind of my overall strategy right now is figure out which sector is being hit the hardest and then finding good opportunities or good times for when the market is really down and it's about to maybe go up. That's the time that I would buy. And I've already put in quite a bit of money into my portfolio already just over the past couple of weeks. And I'm going to continue doing that if the market falls further. So let's take a look at some charts to figure out maybe where the market is right now and where it's going to go. So I have, this is QQQ here. So the moving average is a pretty telling line. This is the 100-day moving average. So it takes the last 100 trading days, takes the average of that, puts a dot, does that across time, and then gives you this smooth line. And as you can see, every time the actual price of this ETF, the blue line here, falls below the 100-day moving average, it doesn't stay below for too long and it just bounces back up. So it comes down, crosses that purple line and goes up again over here as well in 2020. This was in March 2020. It fell along with the rest of the index, especially oil companies. This is where a lot of oil companies drop like 70, 80%. And then it bounced back up to above the purple line again, all the way until recently. This was a couple weeks ago on March 7th. And so here we are right now. Chances are this is going to go up higher because, again, every time it hits that or goes below, it bounces up and it doesn't come back down again for quite a while. So I think there's a slightly higher chance that we have seen the bottom, but of course it's possible we could fall further. And one indicator I'm looking at is the MACD. If the purple line goes higher and crosses above the orange line, then that's a bullish signal and it will make me more confident that markets are heading higher. So until that happens, I'm not certain we've seen the bottom yet. So the next couple of weeks will be very important to watch to get a better understanding of which direction the market might be going in. And as an investor, I'm kind of thinking I have to plan for both scenarios. If it goes higher, I will pretty much just do what I'm doing right now, which is selling put options. If it falls below the purple line again and it continues going down, then I will be doing what I did in the last couple of weeks, which is just buying more stocks. I wouldn't be surprised if Triple Q here falls below like 300, which is right here, over the next month or so. That's definitely a possibility. If that happens, then I am definitely going to be a buyer of a lot of cheap growth stocks because it would be so undervalued at that point. To give you like an idea of how crazy this inefficient market can be. So normally when we think of Facebook or Google or the tech stocks that have high growth rates, we give them a higher price to earnings ratio. That's what they usually trade at. So maybe at a higher PE, like 30 or 40, compared to the more traditional value stocks, the brick and mortar companies, the old companies like Coca-Cola, Heinz, Walmart, Johnson and Johnson, like those stocks, they've been around for decades, if not like over 100 years. Not very volatile, but really steady earnings growth as well as dividend growth. So usually these more stable companies have a lower price to earnings ratio of maybe like 12 times or 15 times. But right now, that's kind of inverted because Procter and Gamble, if we go to summary here, it has a PE ratio of 26, right? And then Johnson and Johnson, 22. So these are pretty high now. Let's look at Kraft Heinz. 46. Now maybe this has a higher growth rate, but it's a food company, so it probably doesn't have a lot of room to grow. Let's see, Pepsi and Coke usually have around the same, but it's pretty high right now. That's almost 30. Let's see, its competitor, Coke, 27. So these are definitely higher than average. And then so let's take a look at like Meta, which used to be Facebook. 15.7 times. So you can see how Meta, which has a higher growth rate in terms of earnings growth and revenue growth than those other companies, is now trading at more of a discount with only a PE ratio of 15. And Meta is, like, you would think for a company with a 15 times PE ratio, it's maybe like single digit growth, or maybe like 10% earnings increase year after year, but that's not the case. I'm going to take a look at, so this is the Morningstar quant report for Meta, and as you can see, the fair value is 338, they think, whereas currently it's trading at 207. And I bought some around 209 at the end of February, so pretty close to what it is at trading today. And I'll just go down here, look at the economic moat. It's very wide because there's not a lot of companies that can compete with Facebook, and it's currently 39% undervalued according to this report, but this is very subjective, so you have to do your own sort of calculations to figure out what the company should be worth today. But looking at revenue growth, like 5 years ago, 2017, it was at 40, and just last year it almost tripled that in terms of how much sales it was making. And since we're looking at PE ratio, like price to earnings, let's look at the diluted earnings per share here. So from 2021 to 2020, it grew by 36%. And then the previous year, from 2019 to 2020, it grew by 57%. So you can see how fast it's growing. The year before that, in 2019, earnings per share did go down. So it didn't lose money. It just made a little bit less than before. But other than that, like if you look at all the other years, they've been growing like more and more. So this, if you average them all out, this it's still double-digit growth. So unless the company like Meta has changed fundamentally, I would expect this number to continue going up. Eventually over the next few years, maybe go up to $20 diluted earnings per share, which is much higher than today. So you have that margin of safety built in there as long as you're willing to hold this company for at least 2 or 3 years. Looking down on the return on invested capital, very high. There's no problems there. It means if you're giving $100 to this company, in 2017, they gave you back $23 of value. So that's a pretty good return on your investment right there. Last year, 28%, right? So why is Meta trading at such a discount, especially compared to, all the other companies in the stock market? It's just because right now, high growth technology stocks are out of favor. Um, but if you look at it from a fundamental perspective, like here's another analyst report from Morningstar, it's way undervalued. Like you have a 5-star underpriced stock here. Now, I'm not recommending people buy this, but just for transparency, I'm saying that I bought 50 shares recently. Same thing with Sea Limited. This is a large gaming company out of Southeast Asia. And if we look at their price to sales, it did go up very high over the last couple of years. But now it's back down to about 4, which is as low as it's been in the past. So I also picked up some shares of C Limited just because it is trading at such a discount compared to the overall market. So can it go down to like 2 or 3 times sales? Yes, but it will not. At least I don't think it's going to maintain at that low level for long. And because the company is still making more and more money over time, eventually the price of the stock will go back up. And I mean, here's what the analysts are. So 25 analysts, the low is thinking it's going to go to 110, but the average here thinks it'll go to $232, which essentially means in a 12-month period, if the average analyst is correct, you're going to double your money. That's 103% um, return compared to what you're paying today. And I bought C Limited at around $100, a little bit cheaper than what it is today. Let's take a look at what this price is. And C Limited is at $122. So just in the last 2 weeks, it's gone up like 20%. Now, this is a very volatile stock. Let's look at the 1 year trend here. You can see the medium term trend, it is going down. I have a 50-day moving average here, and it hasn't crossed that green line yet. So that tells me we're right now at a relatively high short term period, but it's going to fall further because unless the stock price goes above this green line, I don't have a lot of confidence that it's going to go higher. So I bought 50 shares at about 100. If it falls to like $50, I'll buy another 50 shares. And then that would basically lower my adjusted cost base to $75. And I think this stock a year from now is definitely going to be worth more than $100. And if you notice the pattern, like all of the strategies I'm using, they all have require two things. One is you need to find a really good company with growing sales and growing earnings. Otherwise, like none of this buying the dip will work because if you put in good money after bad and the stock continues to fall and you keep buying the dip, but it keeps dipping further, then that's a recipe for disaster. The second thing is you need to be patient. Like for C Limited, if I buy it at $100, 122, $75, probably not going to make much of a difference if 10 years from now this is trading at $500, right? It's more like a rounding error. So I don't get too worried about, picking the exact time as long as I know that the stock is trading at below what it should be trading at its intrinsic value relative to other stocks in the market. What I like about the markets today is you don't have to uh, gamble in really speculative stocks. Like if you take a stock like Google, for example, they own YouTube and a bunch of other services, internet search, huge company, $1.8 trillion is what the company is worth, and it's trading at a P of just 24, which is not cheap, but it's also not expensive. If you compare a company like Alphabet to maybe something that's not going to grow as much, like a Walmart. Let's say a Walmart is trading at about 30 times PE. So would I buy Walmart for 30 times, meaning it's going to take like 30 years to get my money back? Or would I buy Alphabet and just take 24 years to probably less than 24 years because Alphabet is growing faster than Walmart. It has a faster earnings growth over time. As you can see, the 1 year target here, this is what analysts are saying. This is going to be a nice 26.8% return if they are correct, right? And compare this to something like a Walmart. You're not going to see that kind of growth. 165 divided by 145. Yeah, 13.8 is your expected return if you buy Walmart. Whereas for Alphabet, you're looking at pretty much double the return. Again, these are just what analysts are saying. You have to look at the income statement of the actual company itself. But that just goes to show like risk is not equal. So you're expected to get lower returns if you buy Walmart. Now, is Walmart more risky than buying Alphabet? Well, not necessarily, depending on how you define risk. If you define it as higher volatility, then yes, Alphabet is going to give you more risk. But if you define risk as getting left behind in new trends, then Alphabet is actually less risky than Walmart because Alphabet is in a better position to take advantage of any new innovation or to be a part of the future growth and the future story of where the world is going to. Whereas Walmart, they have that online side, they have a lot of technology as well, a lot of patents, but it's, not the same. So in terms of future growth, I would say Alphabet is definitely better at that. And that to me, it makes it less risky than in like an older or more traditional business model. So that's why in the beginning of this month, I picked up another 2 shares of Alphabet. That was part of my $20,000 shopping spree. So I think next week is going to be quite interesting. For the S&P 500, let's take a look at the SPY, which is pretty much the S&P 500, but this is an actual ETF that you can buy instead of looking at the index itself. So we've been going down since the beginning of the year, and it's been falling and going up a little bit. But I have the 50-day moving average line here. You can see how it didn't hit that green line, and then it just went back down. It went up, and then didn't hit that green line again, so it went back down. And this is the overall trend. It goes up and down, but slowly going towards the downside. However, as of just a couple of days ago, as you can see, it did cross over that green line. However, this could be a fake out, and after let's say the next couple of trading days, it falls back below this green line, then that could mean the bottom is not yet in, and we could see this continuing to fall maybe to 400. I think the next FOMC meeting is in May. um, I don't see any surprises in the upcoming like economic data with inflation or anything. I think people are expecting it to continue to stay high. By the way, good job, guys, on the community poll. I asked everyone what you think inflation is going to be, and most of you got it right. Inflation came in at 5.7%. So technically, we did better at estimating that than the professionals. So if you've been watching my previous videos, you already know what my strategy is moving forward. The first thing I'm doing is selling put options. I'm still doing that. The premiums are still really good. So I'm going to earn maybe about $5,000 this month, it looks like. Could be more, could be less. I'm keeping an eye on my margin utilization because if my excess liquidity drops to zero, then my broker can sell my stocks without telling me. At one point, in like the worst time in February, February 24th, with that huge drop in early morning trading, I was at about 30,000 in excess liquidity. That's one of the lowest point I've ever been. So I added more money into my account using my home equity line of credit. Usually I have about 50 to $100,000 in excess liquidity. Right now I have about 120,000, just because I'm preparing for, just in case this is looking at triple Q again. If it falls below this purple line and it continues falling more and more, I'm going to need that extra liquidity in my account to sort of buffer my portfolio so I don't, accidentally get a margin call or something. And if we do indeed see lower prices, I will just be buying more shares. I have a list of stocks that I haven't bought yet, but I'm going to buy them if they get cheaper. So we can either look at market volatility as something to minimize or reduce or something to avoid in our portfolios, or we can embrace the large swings in the market when they come and make a plan for what we can do when it happens. That way, we'll have a strategy that's ready to go and we can capitalize on that opportunity for when the time is right. So for me, that's picking a stock in an out of favor sector, wait for the stock to go below its intrinsic value to buy it, and in the meantime, write put options to earn a continuous stream of income that I can use to then buy those stocks when they dip. I hope that was helpful in trying to understand where the market might be going. Thanks a lot for watching. Happy investing, and until next time.